Before the Federal Reserve, America's banking system was chaotic. Banks were failing constantly, people lost their savings, and the economy was unstable. Today, we'll explore how the U.S. banking system was built and why it matters to your money. The U.S. banking system didn't always work smoothly. From the early days after independence to the creation of the Federal Reserve, there were crises, experiments, and lessons that shaped how banks operate today. By understanding this history, we can see how it affects our modern financial life, loans, credit, and even inflation. After the U.S. gained independence, banks were mostly private, unregulated, and unreliable. During this time, there were frequent bank failures, and people often lost their life savings. The first attempts, like the first and second banks of the United States, faced political opposition and economic challenges. Without a central authority, money supply fluctuated wildly and trust in banks was low. Example: imagine depositing your savings and waking up to find the bank has failed overnight. By the late 1800s and early 1900s, banking crises became frequent. Panic of 1907. A severe financial crisis highlighted the lack of a central banking system. This panic affected the entire economy. Businesses closed, unemployment rose, and people feared their money. It became clear that the U.S. needed a strong, centralized system to stabilize banks and money supply. In 1913, the Federal Reserve Act created the Federal Reserve, the central bank of the U.S. Its purpose: control the money supply, stabilize the banking system, and provide a lender of last resort. The Fed introduced tools like reserve requirements, interest rate adjustments, and emergency lending. This system helped prevent frequent bank collapses and gave Americans confidence in the banking system. Example: during the 2008 financial crisis, the Fed used these powers to stabilize banks and the economy. Today, the U.S. banking system supports loans, mortgages, credit cards, and savings accounts. Understanding how it was built helps us see why interest rates change, how banks manage risk, and why inflation affects our money. Even small financial decisions, like choosing a bank or taking a loan, are connected to this history. From chaotic early banks to the Federal Reserve, the U.S. banking system evolved to protect people's money and stabilize the economy. By understanding this history, we can make smarter financial choices and see the hidden systems that affect our daily lives. If you want more videos that explain how systems and history shape the world, subscribe to Inside the System and hit the bell icon to never miss an update.